Welcome to the masterclass video from the quant section of CFA Level 1. So the first thing I should say for Module 2, which is entitled The Time Value of Money in Finance, the first thing I should say is that we're going to be applying the interest rate and interest rates ideas that we met in Module 1 to different types of securities and derivatives that we find in finance. So we're going to apply the ideas to bonds, we're going to apply the ideas to equities, we're going to apply the ideas to different types of derivatives. We're even going to look at applying TVM ideas to foreign exchange. Now, you might feel a little bit exposed here because we haven't done bonds yet. We do them in fixed income later on. I'd imagine most of you watching this video, if you're going through the curriculum in chronological order, then you haven't been through fixed income yet, and you haven't been through equity yet, and you haven't been through derivatives yet, and you haven't been through, oh, by the way, FX is in economics, all right? So you haven't been through these areas yet. Now, don't get bogged down by that. Don't get paralyzed by this. Just park any questions that you have about the general idea for fixed income, the general idea for derivatives and so on. Park those and just focus on the content here where we're applying essentially rates of return. All right, that's what they mean by the time value of money. We're thinking about rates of return embedded in these instruments, which essentially dictate what we should pay today for cash flows that occur in the future. Okay, so having said that, here's your hit list for Module 2. As you can see, the valuation idea is coming through and we're applying it to bonds, to equity. There's something really crucial in the equity section, something that flows through not just your level 1, but level 2, level 3 as well. Gordon's growth model. Make sure you're on top of that. It's a real absolute need to know formula really that you're going to be applying a lot throughout your CFA program. And then, like I said, at the end here, you've got cash flow additivity applications. It's really just applying ideas that we meet in the chapter to work out what an interest rate in the future might be, a currency exchange rate in the future, what that might be, and to even price our first derivative, an option. Okay, so like I say, don't get bogged down. Just focus on what's in front of you. As much as I can, I'll be putting color on these instruments, but you really should be thinking, I'm not going to master, the different types of derivatives, the different types of options, the different types of bonds, and so on. I'm not going to master these things until I've been through that section. So let's start off by looking at the fundamental idea of valuation. And that is what we'd be willing to pay for an investment today. All right, if you like, it's price according to us, the market, or investors, if you like. We could view it as the present value of the future cash flows we expect to receive, discounted at the required return of investors. So discounting is removing an interest rate rather than applying it. It's the opposite of compounding. Okay, just to give you, a window into what discounting is. Compounding we're more familiar with, and we're doing a lot of that in the previous module. If I deposit 100 today and I earn 10% for a period, what I actually do is I multiply by 1.1 for that period. That's 1 plus the decimalized interest rate of 10%, so 0.1, and I'll get to 110. So that's compounding going forward. You can see with compounding going forward, what we do is we multiply by 1.1. Valuation goes the other way. It says if we're promised a cash flow in the future, what we're going to do is bring that back to today by discounting out, removing, if you like, the required return, let's say it's 10%, and getting to a price that we'd be willing to pay today. Now, if we multiply, when we go forward in time, when we're compounding, we're going to divide. So we'll take this one, we'll do the opposite of multiplying, which is dividing. We're going to divide by 1.1. And what we're really saying is, if you've got an instrument that promises a cash flow of 110 at one period in the future, all right, then you need 10% return from this instrument, then you'd be willing to pay 110 divided by 1.1. So pretty trivial. You'd be willing to pay 100 today. And that ties in with these numbers because it's the same setup, it's the same idea, but the crucial thing with valuation is we're starting with cash flows that are promised in the future, and we're dividing out 1 plus the required return for each period. So that's where this formula comes from. What we'd be willing to pay today is calculated by taking any future value. So we might call this cash flow of future value at time t, where t is 1 in this example, and we discount out our required rate of return for every period. So instead of just coming back one period like we have in this example, we might come back t periods. and you discount out, you divide through by 1 plus R for every period you come back. Incidentally, this could be written as the future value, the future cash flow if you like, multiplied by 1 over 1 plus R to the power of T. All right, so this here is referred to as a discount factor that you multiply through by to bring future payments back to today. In my basic example here, the discount factor would be 1 over 1 spot 1 to the power of 1 because there's only one period. Okay, so that's why it's 1 spot 1 to the power of 1 because there's only one period. And so you're looking at a discount factor there of the inverse of 1 spot 1, which is going to be about 0.9. So it's 0.9091, something like that. That's what you'd multiply the cash flow at time 1 by to bring it back to today. That's what a discount factor is. You multiply through by it to discount back to today. Incidentally, we are assuming that we're using discrete rates, discrete periodic rates of R here in these formulae. If you're using continuously compounded rates, then you know from the previous module, when we use continuously compounded rates, we go forward in time by multiplying by e to the RT, and we discount back by dividing by e to the RT, which is the same thing as multiplying by e to the minus RT. Okay, so there's a little mathematical trick there. If you divide by something, it's the same as multiplying by that thing to the negative power. So, for example, dividing by 2 is the same as multiplying by 2 to the minus 1. All right. So this is discounting with continuously compounded rates. We did discuss using continuously compounded rates at length in the previous masterclass video. Right, so let's get using this valuation idea. Here we've got a zero coupon bond offering a single payment FV at maturity. All right, we can just say let's strip out our required return for as many periods as it takes for us to get this single payment of FV at maturity. So we don't know how many periods it is just from this formula, but time t we get a payment of FV, and we're just bringing that back to today by dividing by 1 plus R for every period. Have a look at this. We've got a strip here from a UK government bond. Now, once again, this is one of those areas, as I mentioned at the start, it's one of those areas where you can park the understanding of a strip until you've looked at the fixed income masterclass videos. It's enough for us to say at the moment that a strip is a zero coupon instrument that you can strip out of a non-zero coupon paying bond. All right. So for our purposes today, in this masterclass, you can just think of a strip as a type of zero coupon instrument. And a zero coupon instrument or a zero coupon bond has no coupons along the way and just one payment at maturity. So this particular instrument offers a payment of £100 in 10 years' time. So there's your T, all right, your maturity. Assuming annual compounding, there's your periods. What should an investor demanding 5% return pay for this security? So that's a true annual rate of return that's required by the investor. What we're going to do is we're going to take the £100 that the security is promising, and we're going to divide by 1.05. That's 1 plus the decimalized return. Remember, 5% decimalized is 0.05. You divide by 100. So our price is going to be 100 divided by 1.05 to the power of 10. There's your T. All right, on the calculator, if your calculator's in the right mode, we did have this discussion in the last module. If your calculator's in the right mode, then you can just go 100 divide 1.05 power 10. All right, and you're good. 61.39. Okay. All right, so a relatively simple example there for a zero coupon instrument. Let's move on and think about what happens after we bought this instrument for 61.39. Let's think about what happens 3 years later. The point of this example here is that we're showing you can back out an implied required return, all right, from a price. You know, our first example had a required return and we calculated a price. You can also go the other way. If you're given a price, like we're told 3 years later, so with 7 years to go, remember there was originally 10, 3 years later there's going to be 7 years to go, all right. That strip that we originally looked at is worth 78.17. Okay, we're still assuming £100 worth of par in the question. Calculate the implied return of the bond. So the solution here is really just calculating a holding period return, isn't it? Like we did in the previous model. You're going to say, look, module, I should say. So, we're standing at time 3. So 0, 1, 2, 3. We know the bond was priced at 60 61.39 at the original time 0. But 3 years have passed, so we're standing at time 3 now. This is our new now, and the bond's trading at 78.17, and at time 10 it's still going to pay 100. So there's 7 years to go. So if you pay 78.17 today, this is today now, time 3, and you get 100 back in 7 periods time, you can just use your basic compound average return, geometric average return from the previous module to say, look, our end value of 100 divided by the start value, right, that gives you 1 plus your total return. If we take the 7th root of that, because there's 7 periods between time 3 and time 10, and subtract 1, we'll get to the compound geometric average rate of return, and that turns out to be 3.58%. Just to show that on the calculator, we have done it in a previous model, but just to show you it again, the keystrokes are not trivial. What you're going to do here, let's just bring them up. What you're going to do here is you're going to go 100 divide, well, not that much, there's the delete button again. Remember, that's the delete button there. So 100 divide 78.17. All right, that gives you your 1 plus your total growth. So you made in total, if you buy this at 78.17, it grows into 100, you make nearly 28% over those 7 years. That's what's in the brackets here. To power up by 1 over 7, remember with the calculator, you power up and you hit 7 and then you flip the 7 over, all right, to get 1/7. And it will do that flipping over before it does the power. When you do the power, there's your 1 plus your periodic rate of return and a geometric average reflecting compounding. You can take 1 off and you're left staring at the 0.0358 that was given in the solution. Okay. All right, so this has been a fairly simple example because we've got price today and 1 cash flow later on. What about a coupon paying bond? Okay, so just a quick word on a coupon paying bond. A coupon paying bond pays a fixed, regular, constant payment and par at maturity. Okay, so for example, have a look at this here. We've got a 10-year, there's the maturity, UK government bond with an annualized coupon rate of 3.5. So there's your coupon. Now it's expressed as a percentage. Now be careful. Your coupon is a percent of par. All right. It's not a percent of price. That's the most common mistake on your route into fixed income. If you're meeting it for the first time, people apply the coupon rate to the price of the bond. It's not. The coupon rate is applied to the par value that is being held. And if you are meeting bonds for the first time, you might think, well, what is the par value? Well, think of par value like a size of holding. All right. With shares, we say, I've got 10 shares. But with bonds, we say, oh, I've got $1 million of par or £1 million of par. Okay. In these questions, we're assuming £100 of par because that's the default to assume is 100 of par. Okay. So we know this bond's paying an annualized coupon of 3.5% of par, and we assume par to be 100. Okay. And it's yielding. So that's the return of the bond. It's actually yielding 4%. So that's what you earn periodically if you buy this bond and hold it to maturity. Okay. Now, we're told something quite profound here, and we're going to need to draw on our knowledge from the first module. We're told the coupon is paid semi-annually. That has quite a profound effect on the numbers that we're looking at, because what it means is we don't get 3.5% of par. We are assuming, by the way, that par, and this is the default assumption, par is 100, unless you're told otherwise. Okay, that's like a default assumption that we use to price bonds, which is what we're doing here. So we're told the coupon's paid semi-annual, so it's not 3.5 once a year. It's actually half of 3.5 twice a year. That's the first implication of this coupon being paid semi-annually. Okay, what actually happens is we get the coupon payment. Whilst a year we get 3.5%, actually what we're going to get is 3.5. You know, when you apply that to 100, it remains 3.5. It's trivial, right? So your coupon payment is going to be 3.5 divided by 2, which is 1.75 every 6 months. Okay, so that's one implication. Be careful with that. The other implication that you've got to be careful with is this. As soon as we find out that coupons are paid semi-annually, what we realize is that that is a nominal stated rate, okay, with semi-annual compounding. All right, so this 4% is not really 4% a year. This is our module 1 knowledge. This is a flat stated rate compounded semi-annually. All right, And so really what it is with 2 periods a year, it's actually 2 times the true semi-annual return of the bond. All right, that says true semi-annual return of the bond. This is drawing on our Module 1 knowledge. So actually our true semi-annual return of the bond is going to be the stated rate 4% divided by 2, all right, which is 2%. And these are the parameters that you now work in. You're guided by the periodicity of the bond with regards to the periods that you work in. You're told the bond pays a coupon semi-annually, therefore you go with a semi-annual coupon of 1.75 every 6 months and a semi-annual required return or return of 2%. Okay. So what is the price of the bond? Now, this is the first time we're going to use the TVM keys of the calculator. What are the TVM keys of the calculator? It's this third row of buttons here. All right. Now, these are masterclass videos, so I'm assuming you've used these before, and we'll just go ahead and use them. But it's important that you essentially interpret the information correctly, because when we think about what we're going to hit for N, we've got a 10-year bond, but it's not 10 periods, is it? It's going to be 10 times 2 semi-annual periods, which is 20. All right, now before I begin, I should clear my TVM, which second FV clears your TVM. Okay, 20 periods, so 20N is the first thing I put into these third row buttons. Okay, then when it asks me about IY, I've just said that it's 2% every 6 months, which is the periods that we're working in. So 2 IY, and then the PV is what we're looking for. PMT is the periodic coupon rate, which we've said is not 3.5 a year, it's actually 1.75 every 6 months. I mean, it is 3.5 a year, but we're working in 6 monthly periods. So 1.75 PMT, and then don't forget the par payment at the end of 100. Okay, that's your FV. All right, so 100 FV. Right, now I've populated all the keys of the calculator there, the TVM apart from the one I want, so I can do compute PV, and I get 95.912 negative because I need to pay it out to receive these cash flows. And that's what should be happening when I bring the solutions up here, 95.91. So there you go. We're seeing that the solution is saying it's actually 3.5 over 2 that's paid periodically, and they agree with us. 20 semi-annual periods, 2 periodic return, which is the quoted yield divided by 2. We spoken about the coupon, 100 FV, and then we compute PV, and we get the number we first thought of, 95.912. So that's good. That agrees with us there. All right. Of course, this was looking at a price given a required return. Once again, you can go the other way. Given a price, you can back out an implied required return. So let's have a look at that here. Let's have a look at that here. So 3 years later, that same bond in the previous example is trading at 101 per £100 of par. Calculate the implied annualized return of the bond. Now be careful, when you annualize this bond, you are going to give a stated rate. And remember, stated rates, all right, stated yields are the true periodic return, just scaled up by the coupon frequency, the number of periods per year. All right, so we called it M in the previous module. It's the number of periods per year. So what you're going to do with the calculator here is you're going to calculate a periodic rate of return implied by the cash flows of this bond and its price, and then you're going to scale up by the coupon periodicity, which remains semi-annual. Don't forget this bond, as we were told, if it's the same bond, it's semi-annual. Now look, if 3 years have passed, originally we had 10 years to go. If 3 years have passed, then that means there's not 10 years to go, there's only 7 years to go. And of course, 7 years is 14 semi-annual payments, okay? It's the same coupon, right? Now, this is why we call it fixed income, remember, all right? The cash flows are fixed, all right? That's why we call it fixed income. You'll see a lot more of this in fixed income, obviously. So there's the coupon payments, all right? There's now only 14 of them left with 7 years to go. And here's the par payment as well. Remember, we've standardized to £100 a par. Now, that price would go out today if we bought the bond, wouldn't it? So what we're going to do is we're going to clear our TVM keys. All right, so second You should be getting into the habit of doing this every time you use the TVM keys. You go second FV to clear the TVM keys. You can clear the screen as well. So don't need that number anymore. Then you can start populating everything. You're going to end up going compute IY this time because you're calculating a required return. Now, there's 7 years to go, which is 14 semi-annual periods. So 14N. If I do the animation on the slide, that will bring that up. There it is. Okay, so 14N. And then 3.5 over 2, 1.75 PMT, that's the regular payment, same as before. 100 FV, same as before. What's different this time is this bit here. 101 negative PV. You've got to get the sign right here. We're going to pay out away, all right? 101 negative. That's going to be our PV. That's what we're paying for those cash flows today. Okay. So with all that information in, the only thing that's missing is the periodic rate of return. You can compute that now. Compute IY, and you get 1.67%. Okay. Now this is where you've got to really think. What did I just calculate? Because if you forget, the examiner's going to hunt you down here. The examiner's going to offer you 1.67, as the yield of this bond. And if anyone that picks it will experience woe, right? Because that's the true semi-annual rate of return of the bond, isn't it? Yeah. If we go back to the discussion we had at the start of all this example, you've just calculated the true periodic return, the true semi-annual return of the bond, this thing here. You need to scale it up by 2 times because it's a semi-annual bond to get to a quoted stated yield. Okay, you'll do this a lot in fixed income as well. So take that 1.7-ish, 1.67-ish, multiply it by 2. All right, the compounding frequency, played the role of M in the previous module, number of periods per year. All right, and you get to 3.34, and that would be the annualized quoted yield of the bond here. Okay, the curriculum goes on to look at the cash flows of a loan now. Very similar idea, but a different type of contract, a different type of investment. When you invest in a bond, remember bonds are fixed income, you get fixed coupon and par back at the end for your most usual type of bond. With a loan, if the loan is fully amortizing, in other words, it's fully paid off over its life, what you get back is a series of fixed payments, but those fixed payments are paying back both principal and interest of the loan. So you don't get any par payment back at the end, which for the bond really represented the loan size. With the loan, your payments pay down the balance, the principal or par amount over the life of the loan. So let's have a look at this example. What it means here is we've got a regular cash flow. We've got no FV, no par payment at the end for a loan. You've got a homeowner taking out £500,000 mortgage, 25 years. Be careful with your periods because we're going to work in monthly periods because that's when payments are made. There's a fixed rate of 6%. Now that's an annual rate. All right, rates are annual unless you're told otherwise. Okay, so we need to calculate the fixed monthly payment, assuming that we're fully amortizing this loan down to 0 over its life. And then we're going to calculate the split of interest and principal for the first payment and the last month's payment. Okay, the calculator is going to be doing quite a bit of heavy lifting here. Let's have a look at this. So first thing we're going to do to calculate the fixed monthly payment, we're going to use the TVM keys. Now, we're going to, as always, get into this habit of clearing the TVM. Second FV clears the TVM, clear the screen as well. Okay, and now just be careful with this loan. Yes, you've got, when we're thinking about the number of periods, yeah, you've got 25 years, but we're working in months. So when we take our 25 years and scale up by 12 months a year, we realize we've actually got 300 periods. So 300N, okay? With regards to the periodic rate of return, we're quoted a rate of 6. However, that's an annual rate. To turn it into a monthly rate, if that's a flat quoted rate, we just divide that 6 by 12, all right, to get half. That's your monthly rate of return or your monthly interest rate, okay? With regards to the present value of the loan is the original balance of the loan. That you can view that 500,000 as the present value of all later cash flows discounted at the interest rate of the loan. So that is the present value of all cash flows. Just put that in as PV. And then given that the loan is fully amortizing, there's no par payment at the end, like there was for a fixed coupon bond, okay? So what we can do now is we can go compute PMT to get the regular payment that the borrower needs to make, right? If we've got that 500,000 as a positive coming in at the start, this is going to tell us that the borrower needs to make a payment of 3221 spot 5 out each period. Okay, so the slides should be agreeing with us here, which they are, which is always good. Now, not all of the calculator worksheets are particularly useful, I find, but some of them do punch way beyond their weight. And here's one of them. It's the amortization worksheet of the calculator. You get there by going second PV. The second function of PV on the calculator is the amortization, the word amort, as you can see here. All right, so what is this worksheet doing? Well, given a loan schedule that's been put into the TVM keys, right? So you must have a loan schedule fully input into the TVM keys, which we do. We just did it. That's what we just did. By the way, you can always see what's in your keys by going recall N. Oh, there's 300 periods. Recall IY, 0.5% a period, and so on, right? Now, given that you just put everything that you needed to put in, FV is defaulted to 0, and then you compute PV, everything's there. You can go second PV and you can interrogate this loan schedule. And what I mean by that is you can think about how much interest, how much principal, and what the balance is at any point in time, even like over a subset of the loan. Okay, so we're interested firstly in the first month of the loan. All right. So if you like, the subset of the loan that we're interested in starts at month 1 and ends at month 1. So that's why I'm going to make P1, which is the subset that we're interested in. That's where it starts. We're going to make that 1, enter. Then I'm going to arrow down and I'm going to make P2 1 as well. What I've told the calculator there is that I'm interested in a subset of my loan that starts at month 1, that's P1, and ends at month 1, that's P2. So I've just told the calculator I'm interested in month 1, right? When you arrow down, you see that the outstanding balance at the end of what you're looking at, month 1 in this case, is 499,278. In other words, you paid a bit of the loan off, but not much. When you arrow down again, it tells you about the principal that's been paid off during this subset of the loan that you're interested in, which is just month 1. So that answers one of our questions, right? Principal 721 spot 5. That's the amount of principal that's paid off in the first month. All right. And then the interest that's paid off, you arrow down again, you'll see the interest is 2,500. Okay. Notice that those two payments add up to the PMT that we calculated in the first instance, right? We're just splitting that single payment out into interest and principal. Notice also that most of the initial payments, the payments that happen at the start of the loan, are interest, because you've got a big loan balance. Most of the payment is just paying off interest. When we look at the 300th month, which you can do now, you can go back to your amortization P1 and P2. So arrow up, and you can set P1 equal to 300. All right, that's the 300th month is the start of the period we're interested in, and then the final part of the subset that we're interested in is the 300th month as well. We're telling the calculator there we're just interested in the last 300th month. What we can do now is arrow down. Guess what? We've paid off the loan with a bit of rounding. We've paid off the loan. The principal that was paid off in the final month was a whopping 3,205. So it's mostly principal, not a lot of interest, because most of the loan has been paid off. Right? Look at that, only a tiny scrap of interest. They agree with the numbers here, and what you'll find is those two numbers once again add up to the constant payment that we're paying. All right. So take away the idea here that it's a constant payment, but the split of principal and interest changes. It's mostly interest at the start, mostly principal at the end, towards the end of a loan. That's why you should pay down loans sooner rather than later. Particularly if you think rates are going to go down, and you're going to end up, paying a high interest rate. All right. Just a brief word. I'm just thinking there's something else I want to mention. Yeah, I just want to make it clear what the difference between P1 and P2 is. If I were interested in the first year, it's unlikely for the exam, but if I was interested in the first year of this loan's life, I'd do P1 is 1, that's the first month. I'd then do P2 is 12, that's the 12th month. So I'm interested in the first year. It's telling me at the end of the first year, the balance outstanding is about 491,000. During the first year, principal paid off is about 9,000, as we've just seen. All right, essentially, and the interest paid look at that. The interest paid in the first year of this loan is nearly $30,000. All right, or pounds, or whatever it's denominated in. Okay. All right, now we're going to move away from bonds and loans and we're going to start thinking about equities. All right. So equities, of course, they don't mature. They don't ever go to maturity. What we can do in the most simplest form of equity, like a preferred stock that just pays a, preferred stock tends to pay a constant dividend. And if it's not redeemable at any point in time, then you can view it as what's called a perpetuity. It never redeems, it goes on forever, but it is fixed in what it pays. Now you can value a fixed perpetuity. Don't do it like payment by payment because there's no, they go on forever. Don't sit there and start adding up, CF1 or the first cash flow divided by 1 plus R plus the second cash flow divided by 1 plus R squared plus the third cash flow divided by 1 plus R cubed. Don't do that. That's going to take a long time. All right. What you do is you hand it to a mathematician. You say, hey, Mathmo, what happens as t goes to infinity? Is there a limit? And the mathematician goes, oh, we know that one. We've known that one for centuries. In order to work out that infinite sum, because it gets smaller as t gets bigger, the present value gets smaller, it does pretty much go away. And it does converge to a finite level when you add it all up. And you can just take the cash flow and divide by the required rate of return. And you say to the mathematician, really, is that it? And the mathematician says, yes, that's it. And you say, thank you. And then they go away, right? So all you need to do is take the cash flow. Have a look at this example here. Preferred stock, constant dividend of 50 cents per share into perpetuity. Calculate the price of a share if the investors demand a return of 8%. Just make sure you decimalize that R, because you're not going to get a good result if you divide by 8 here. You do need to divide by 0.08 and get €6.25 per share. If you think about it, if you pay $6.25 for something that pays 50 and then you sell it for $6.25, your only return is the 50 that comes in periodically, and that return, 0.5 divided by 6.25 by definition is the 8% you demand. So, we do get back to the number we first thought of. Now, look, whilst that isn't massively complex, it is very, very important that you understand that a perpetuity factor is just 1 over R, or you just divide by R to calculate the present value of an infinite stream of fixed cash flows. But what about if the cash flows grow? Now, I'm going to just make a key point here before I move on. Please do pay close attention to the fact that what we've just calculated here is the value at time 0 of a series of cash flows where the first cash flow happens at the end of the first period. So the first cash flow doesn't happen until time 1. It's very important that you realise we're not including any cash flow that happens at time 0 here. If you like, that's just happened and we're looking forward. Right? We're buying the stock ex dividend, if you like. Right? The next question is, what happens if the cash flow grows? What happens if this cash flow here isn't constant, but it grows forevermore? Well, you might think, well, that's certainly going to mean that the sum is infinite and so on. But actually, it doesn't. As long as the growth rate is less than the required return, your summation does converge. And all you need to do, this is the nice way to think about it. If you've got this under your belt, the value of a constant perpetuity is cash flow, next cash flow, technically, at time 1 divided by R. You can think, well, guess what? If my cash flows grow at a constant rate of G, then I can take that off of what I require, right? Because I'm getting them in the cash flows. I'm getting that return in the cash flows. And that's it. What you've done there is you've adjusted this little relationship for constant growth in the dividends or whatever cash flows you're looking at, right? The value today of all cash flows from time 1 to infinity, where the cash flows grow at a rate of G and G is less than R, the required return, is simply next cash flow. I'm going to just make a big deal about that, right? Next cash flow. Here's my big deal. It's CF1, the next cash flow that grows forevermore at a rate of G, divided by R minus G. Okay, that gives you the value at time 0 of CF1 and forevermore. Notice that this is an ex-dividend valuation. CF0 is not included in this valuation. If G happens to apply between time 0 and time 1, then you could always use CF0, cash flow 0, or the dividend at time 0. You could always grow it into CF1 as by multiplying CF0 by 1 plus G. All right. However, this is a very important point. G doesn't have to apply in that first period. All that's required for this model to hold is for CF1 to grow at G forevermore. So you could just be told that CF1, the dividend at the end of the next period is 100, and it's going to grow forevermore at a certain rate, and you can get the value today. However, if we make the assumption that G does apply between 0 and 1, then we can inflate the cash flow today to get CF1. Note that doesn't mean our valuation includes CF0. It doesn't. We're just using CF0 as a tool to get CF1 when G applies in the first period, which is what happens with Shipline here. This is actually a CFAI example. It's currently got a dividend of $1.50, so that's D0, all right, which is, not really of interest to us unless we're going to use it to get to D1, which it looks like we are, because G's 6%, it's going to grow forever, and so we can use D0, grow it by 6% to get D1, okay? Calculate the price of a share if investors require a return of 15%. So we see here that the required return is greater than the growth rate, so this equation is going to hold, okay? What we can do is take our D0, all right, grow it by a factor of 1 plus G in decimalized terms to get D1. So what you've got on the numerator there is D1, okay? This is all D1 when you inflate D0 by 1 period. So next cash flow. And then you can divide by R minus G. What would I do on the calculator here, just to speed you up a bit if you're still kind of tapping a lot on the calculator? I would say, look, I don't really want to use those brackets on the denominator, so I'm just going to look at it and see it's 0.09. If I couldn't see that that was 0.09, in other words, if the numbers were a bit more messy, what you might do is do the calculation on the denominator, right? And then flip it over. There you go. And that puts it on the denominator. Yeah? And then multiply by, I flipped over there by hitting the 1 over x key, okay? Then just multiply by the numerator. So multiply by 1.5 and then multiply by 1.06 to get D1. All right, and we get the 17.67 we first thought. Now, that is Gordon's growth model. You might remember in the original hit list, the original Need to Know concepts, we mentioned Gordon's growth model. This is it, Gordon's growth model. And, you can use it for any type of cash flow that's growing forever. All right, and this is probably, if you cut the CFA program down the middle and looked down it, you would see running through it the Gordon's growth model, because it gets applied a lot at level 1, it gets applied a lot at level 2, and it gets applied a lot at level 3. So get that on your belt, get that under your belt, right? And if you've got a belt, put it on it as well, right? But don't take the belt into the exam. Okay, we're going to apply this a few times. In fact, we can always use Gordon's growth model when infinity rears its head, right? Don't forget, we're looking here at the present value at time 0 of cash flows that happen after time 0, right? Infinity is in play here. Whenever infinity rears its head, you can use the Gordon's growth model to basically take the sting out of its tail. So let's have a look at this. We've got Shipline stock again, but this time we've got D0. We expect a supernormal growth rate, a high dividend growth rate for 3 years, a finite time, and then the dividend will grow at a more sustainable, lower long-term rate forevermore. All right, so that's where infinity raises its head, and that's after 3 years. Required return is 15% again. Okay, so what you're going to do here is draw a timeline, and you're going to say, okay, when does the growth first occur? When does the growth, the perpetuous growth, to which dividend does the perpetuous growth first start happening? I know I've got a D0 of £1.50 here. That's in brackets because don't really care about that. I am going to use that and grow it by 6%, all right, to get to the next dividend. Now, when you grow $1.50 by 6%, you get, it's not a dollar, is it? It's a pound. When you grow £1.50 by 6%, you get 1.59. So that's my dividend here, all right. And then, you can keep doing that. Grow it by 6% again, all right. So take your 1.59 and grow it by 6% again. Really, you're multiplying £1.50. If I switch from dollars to pounds, I do apologise if I just did that again. So £1.50, 1.06 squared, you get to 168.5, all right, 1.685. And then do it again, and that's the end of your kind of finite period. You get to 1.787, all right? So hopefully you can do that on the calculator, 1.787. Now, the important thing to realise is that it's this dividend that grows forevermore at 2%, okay? And so you can use Gordon's growth model and stand here and get a value at time 2 of all those dividends that happen after time 2, all right? Because you only need to identify the dividend to which perpetual growth applies, and then you can stand one period before that, V2, and calculate the value of all those dividends forevermore. It's very important that you realize that we're standing at time 2, the start of the first period, where constant growth is going to apply forevermore to the dividend that happens next and forevermore. Okay, so what we're really looking at here is applying it to D3. V2 is calculated by applying it to the next dividend, D3. Okay, just in the same way that when we're standing at time 0, the value at time 0 of everything that happens after time 0 is calculated by using the next dividend or the next cash flow that happens at time 1. There's still that 1 period lag between the valuation and the first cash flow. Okay, very important. It's probably up in the top 3 errors that people make when they're applying Gordon's growth model. Okay, so I've identified this pound 787, all right, as the first dividend that will grow at 2% forevermore, and I can apply Gordon's growth model to that. There you go. I called it V. P is just as good. So P2 is going to be D3 to which constant growth applies forevermore, divided by R minus G. That's Gordon's growth model, all right, being applied. And so if we take out D3, which we've already agreed is £1.787 here, and we divide by R minus G, all right, R is 15%, G is 2% over the long term here. Once again, you could just take 1.787 divided by 0.13, and you get 13,746. Now, it's important for you to always keep on top of what that is, right? It's not the calculations that are important on their own. It's what, interpreting what comes out of them. That is the value at time 2 of all dividends that happen from time 3 to infinity, okay? All you need to do now is bring that value at time 2 back to today by discounting by 2 periods, all right? So take that value at time 2, V2, P2, same thing, all right? Discount it by 2 periods. That's happening here. All right, 13.746. That was the V2 that we got, the P2 that we got. All right, discount that back by 2 periods to bring it back to today. All right, don't forget that V2 is the value of dividends at time 3 and forevermore. So we've got to include D2 as well. That's a common mistake, is that you forget D2 at this stage. That goes in here. Remember, we calculated that a long time ago. There it is, £685, apologies. As you can tell, I'm used to working in dollars in these examples, but CFA Institute have got a bit more international of late. And then don't forget D1 as well. All right, D1 is £1.59. All right, dollars and pounds are pretty much the same thing these days anyway, aren't they? But yeah, make sure that you use the right power here for the discounting, and you're good. If you're calculating the right mode, see Module 1 for that, the video for Module 1 if you're worried about the calculator, then you can just type this through. All right, you don't actually, this is where the AOS mode really comes into its real power, because, if you excuse the pun, because I can, if I'm in the right mode of the calculator, 1.59 divide 1.15, all right, plus 1.685 divide 1.15 squared, plus 13.746 divide 1.15 squared. Look at that. Boom. It comes out all in one go if you're in the right mode of the calculator, which is cool. If if you can't do that, change the mode of the calculator. Just quickly, second dot up. You should be in AOS mode. If you don't see that, hit second enter and you'll change to AOS mode. But I'm not going to go through that again. That's the last time I'm going to mention it. Okay. All right, now that for me, that's listed in the slides as approach 1. That for me is the sensible way to do it. All right, you will see in texts, like in the curriculum, and we have to represent it as well. You will see in texts that sometimes solutions are done in a slightly different way. In my view, an inferior way that takes longer and is more prone to mistakes. But there you go. So there's an alternative approach where you just treat the supernormal dividends independently to a terminal value at the end of the supernormal dividends. Gives the same answer, right? And in my view, it's a longer. It takes longer, but you'll get the same result if you simply say, right, we'll take those first 3 dividends. They're the same as before. We calculated them before. Then all we'll do is we'll discount those back to today, just to deal with the finite stuff. All right, and then I'll actually calculate D4. Now remember, D4 is the first dividend that after time 3, so we've got to inflate it by the 2% stable growth rate that happens after time 3. So there's that there on the top there is D4, and we can apply R minus G on the bottom there to get the value at time 3 of all dividends in the more normal growth, the lower stable growth period. So D4 to infinity. So that's what that 14.021 is. That is the value at time 3 of all dividends from time 4 and thereon. So I guess this approach is really just breaking out the finite supernormal growth, 6% 3 years, and then the more stable growth, lower growth. All right, comes to the same answer, but it does involve an extra calculation, as you can see, because we apply Gordon's growth to D4. We have to calculate D4, apply Gordon's growth to D4 to get 14.021, which is the value at time 3 of all dividends after time 3. Then we've got to bolt these two together and discount them by 3 periods and discount D2 and D1 back as well. And that's what's happening here, of course. All right, so back comes the payment at time 1, back comes the payment at time 2, and back comes the sum of these two things. When you add 1.787 and 14.021, you should get that 15.808 value at time 3. And that gets you to the number we first thought of. So that's another way of doing it that you might see in the books. My recommendation is to go with approach 1, which actually involves far less calculation, speeds you up, and is less prone to error. All right, now I can't emphasize enough how important Gordon's growth model is and how you should be applying it. It is very important. And so there it is. Once again, let's just bask in its glory for a second. Incidentally, if you rearrange this thing, you can solve for an implied required rate of return. Turns out that required rate of return on something like equity that's got a growing set of cash flows, like a growing dividend, is D1 over P0, which is just your income return looking forward for the next year, plus G, which of course is your growth. So that's really saying something we knew all along. What do we require from equity? We require income and growth. Current income for the next year and growth on that income. That's what we require. If you solve for G, your growth rate that is implied by a share price essentially and a required rate of return is really what you're requiring in excess of income. All right, so whatever you require, your requirement in excess of income, it must be your requirement for growth. Okay, so this stuff here is actually, we don't need formulae to tell us this. This is almost common sense. But, we're rearranging the formulae to see them explicitly manifest in this way. If you don't like rearranging formulae, you don't have to do it at level 1, and I wouldn't recommend doing it anyway. You've got a multiple choice setting where there's 3 answers in front of you. One of them is right and 2 of them are wrong. Try the middle one, which will be the middle ranked one. It'll be smallest at the top, middle in the middle, largest at the bottom, usually, but they will be ranked. Try the middle one. If it's right, then it's right. If it's not right, you can usually adjust and say, well, I need to use a bigger number, so I'll pick the bigger one, right? Or I need to use a small number, so I'll pick the small one. Now we're going to use a CFAI example here, and just like in Module 1, when we come to these rather verbose and convoluted CFAI examples, what we find is that the solution is a lot more straightforward and succinct than the question itself. For example, look, we're actually looking at Coca-Cola stock trading at $63, and it's got an expected dividend of $1.76. That's the periodic annualized dividend. If we expect dividend per share to grow at 4%, that's a G. All right, what we can do is use our common sense, right? What do we require from a stock? We require income, all right, and growth. So we can back out what investors must be requiring from the stock. They require income yield, if you like, dividend yield, income return of 176 over 63, as a proportional price, plus growth of 4%. So investors are demanding 6.79% from Coca-Cola if your numbers are right. Right? This is the thing with valuation and so on. The models are fine, but the real super billion-dollar question is: are you, what are you putting in, and how are you interpreting what comes out? The example goes on to consider what would happen if you revised your required return assessment, and you said, well, you know what, we need 7% from this stock. Now, for the same income level, same price and same income level, these are facts, not opinion. If you change your opinion and you say we need 7% return, that means you're going to need more growth, right? The implied growth when we require 7% is the 7% minus the income return or the dividend yield. And that comes out as 4.21. So that's higher than the 4% that was priced in before when we assumed a lower required return. All right. The idea here is that when the required return is 6.79%, we're pricing in a growth rate of 4%. Okay. However, if we decide actually we need 7% from this stock due to the risks of the company and so on, then we require more growth than is expected. So maybe you would say here that with a higher required return and expected growth of only 4%, this stock is overpriced. That's what you'd start saying here. Okay, being in the valuation section, it's difficult not to mention the PE ratio. More on this in the equity section later on in the curriculum, but a PE ratio is really looking at how much you're paying in terms of share price relative to the earnings the company is generating per share. The crucial idea here is that earnings give us dividends, and in the end, as a shareholder, you know, your returns come through dividends. I know share prices go up and so on. You can buy them at, you know, low and sell high, but really changes in share prices are related to changes in earnings, aren't they? So earnings are a key value driver. If we were to back out from a fundamental perspective, like from a formulaic perspective, from Gordon's growth, there it is again. All right, from Gordon's growth model, if we were to back out a price to earnings ratio, what we would do is take our price and divide by earnings. Now let's look forwards. So let's divide by E1, next period's earnings. That's me dividing the left-hand side by E1. If I divide the right-hand side by E1, to keep this equation holding, I'd divide the numerator by E1. And that thing on the top there, D1 over E1, that is the payout ratio of a company, what the company pays out as a proportion of its earnings. So it's its payout ratio. Notice we've got good old R minus G on the denominator, as it usually is in a valuation context. So what is this? What are we staring at? Payout ratio over R minus G. What is it? That is your fair PE ratio. You know, if you calculate this and it turns out to be 12 times, you can then look at your stock's actual PE ratio. If you're paying 13 times, that's too much. If you're paying 11 times, that's cheap. That's a bargain. So this is like a benchmark for what PE ratio the stock should be trading on, all right, what it should be, and then you can look at what it actually is. And if you're paying less than this fair PE, it's cheap. If you're paying more than this fair PE, then it's expensive. More on this in equity and valuation later on. So here's a CFAI example focusing on the PE ratio, once again for Coca-Cola. All right, so Coca-Cola trades at forward price to earnings. So it's forward price to earnings because we're looking at P0 today versus E1. There's the actual ratio, 28, which is pretty punchy. All right, don't want to get into too much discussion about PE ratios. It's not really not really the course for that, but that's pretty punchy to me, 28 times. Expected dividend payout ratio is 70%. 70% is your payout ratio, all right? And that's going to be the numerator of your fair PE ratio when we calculate it. Coca-Cola stock now should earn 9%. It's getting riskier, right? More risk, more required return. Dividends will grow by 4.5%. Okay, so you're given these numbers, and once again, these are the billion-dollar kind of numbers. Like, what are they, and are you good at estimating them? So, recommend a course of action. So, fair PE, where the PE should be, is payout over R minus G. Make sure you use decimalized R's and G's. All right, so take your payout of 0.7. Use decimalized payout ratio as well, by the way. You've seen me do this before on the calculator. You can speed this up a bit by going, do the denominator first. 0.09 minus 0.045. That's your R minus G. Okay. It turns out to be 0.045 itself. You can put that on the denominator by just hitting 1 over. There you go. 22.22. And then multiply by the numerator. 0.7. All right. And you come out at 15.56. So that's great. That's the fair PE. Now, I did say that looks pretty punchy, that 28. I'm not going to pay 28 times earnings for something that should be on a multiple of only 15 times. So that looks like it's overpriced to me. All right, and stay away from it at best. And if you're inclined to be particularly active about this view, then take a short position and benefit as Coca-Cola underperforms the market as it readjusts to its fair valuation. Right, the final section of this module looks at something called cash flow additivity, the principle of no arbitrage, the law of one price. They're all the same thing. The idea here, and this is used a lot to calculate fair rates of exchange, fair interest rates, fair deferred prices, like in derivatives that we pay later on, things like that. As you can see in the examples that are coming through, the applications that are coming through here. The idea here is if you've got two similar sets of cash flows, and when I say similar, I mean exactly the same, that are being generated through different securities, then these securities should have the same value today. Otherwise, you could buy the cheap one, sell the expensive one, and make risk-free profits. That's arbitrage. The principle of no arbitrage is that actually you can't do that. You shouldn't be able to do that in inefficient markets that are in what's called equilibrium. There shouldn't be the opportunity to buy something and sell the same thing, just with a different name, and make risk-free profits because you haven't taken any risk. So there's, that's the underlying principle of no arbitrage. You shouldn't get return in excess of a risk-free rate, I should just clarify, all right, for taking a riskless position. So therefore, two things that have the same essential fundamental cash flows, even though they might be trading by a different name, if they have the same underlying essential cash flows, then they should have the same price today. Okay, so a very basic example would be looking at maybe combining a load of different bonds with different individual cash flows and getting the same cash flows as a long-dated bond with a series of coupons. If you do that, then the coupon-paying bond that pays all of the cash flows should be trading at exactly the same price as the sum of the bonds that pay the individual cash flows. All right. Otherwise, you could trade the individual cash flows versus the bond, which has cash flows comprising all of the cash flows in question. You could buy the cheap one, sell the expensive one, and make risk-free profits. This principle of no arbitrage is profound because it can be used as an assumption that markets are efficient enough that no arbitrage exists, and then we can back out what the price of a future transaction should be, or what the price of a derivative even should be. So these are the applications that we're looking at. Now, I've said this a couple of times already, but I'm going to say it again. Do not get paralyzed by a lack of understanding of the term structure of interest rates. That will be covered more in fixed income. All right. It might even be worth parking this until you've done fixed income and coming back and going, oh yeah, that's forward rates, that's fine. Similarly with forward currency exchange rates, it might be worth just parking this and saying, I'll come back and look at this after it's covered properly in economics, all right, the foreign exchange section of economics. All right, that would be actually it's not a joke recommendation that you park this stuff and come back and look at it after you've covered it properly in the relevant areas. Option pricing obviously is covered in derivatives. So I don't necessarily really fully understand why the curriculum applies time value of money or cash flow additivity and no arbitrage principles to contracts, securities that we haven't met yet in the curriculum, but it does. Okay, so what we're going to do is we're going to look at these examples almost in like a bubble. All right, we're not going to worry about the big fixed income ecosystem or derivatives ecosystem. We're just going to look at the example in front of us, and what you need to do is not worry. If you're worried about getting the full picture on these asset classes and these derivatives and so on, wait till you've had a look at them properly. Having said that, a forward interest rate is, as the name suggests, an interest rate that is implied for a period that starts in the future. All right. For example, F11 is a rate that starts at time 1 and goes on for one period. Okay, so that's the terminology that's used. Once again, we'll do this a lot when we get into fixed income. Now, if you're given a series of zero coupon bond prices, remember those strips are just zero coupon bonds that just pay par payment at maturity. What you can do is you can back out of these zero coupon bond prices an implied rate of return for a cash flow at a certain point in time. For example, on the 31st of May, right, just ignore the second row for the time being. There's enough to deal with the first row here. So on the 31st of May 2022, this is the CFA example, you observe that the price of a 1 year zero coupon bond is 98.028. What that means is you could, on the 31st of May, all right, I'm going to ignore the second row because it's getting in the way. It's too noisy. All right, on the 31st of May 2022, you could pay out 98.028, all right, and you will get back in 1 year's time, all right, so 31st of May in 2023, you'll get back 100. Don't forget you get back par on these zero coupon bonds. Now there is an implied rate of return, isn't there, from paying 98.028 today and getting 100 back in 1 year's time. That implied rate of return is just your end value of $100, right, divided by the start value, the price that you paid today. All right, that's n divided by start. All right. We don't need to deannualize, or we don't need to annualize this because it is over a year. We can just subtract 1 and we've got an implied rate of return. Incidentally, the formal name for a rate of return implied for a single cash flow at a certain maturity is referred to as a spot rate. Once again, more on that in fixed income. So these strips, these zero coupon instruments whose returns are called spot rates, the 1 year return in May is just simply 2.012. Okay, that's what that number is telling you in this table. This number in this table is telling you that at May, once again, in May, you could pay 95.109 out today and then wait 2 periods and receiving a cash flow of 100. Okay. Now, there is an implied periodic rate of return associated with that cash flow after 2 years. And it's calculated as follows. Like these are holding period returns like in module 1, right? Take your end value of 100 that you receive after 2 years here, divide by the start value, which is the price that you're paying today, and make sure you take that 1 plus total return, which is inside the brackets here, and you take the square root because there's 2 periods. So this is the periodic, these are the annual rates of return implied by these prices, okay? Get 2.539. All right, now I'm going to assume you can do that on the calculator because that's relatively straightforward. I'm only going to focus on the May numbers because the June stuff is just going to get in the way. It's just a bit noisy. So once we've got these rates that individual cash flows are earning, what we know at this stage is we know that if I invest out to a cash flow at time 1, I will earn a rate of 2.012 for 1 period. All right, so 2.012. I also know that if I invest out for 2 periods, I will get each period, I'll get 2.539. Okay, 2.539. Now this term structure of spot rates, as it's called, its formal name, implies a forward rate, a fair forward rate that we should be happy locking in today. All right, we actually should be happy locking in that forward rate today. It relates to a future period, but we're happy locking it in today because we can lock in a rate to the start of the forward period and to the end of the forward period, those rates being the rates in question. All right. Now look, you should respect compounding, but there is a no arbitrage. Here comes the no arbitraging principle. The no arbitrage principle says getting the 1 period rate and then getting the forward rate should be the same as just getting this 2 period spot rate. That's the no arbitrage principle. In other words, you've got 2 routes to going into the future. You've got 2 routes from time 0 to time 2, essentially. You could either get 2.012 and the forward rate that we agreed today, or you get 2 lots of this 2.539. Okay, so that's where, if we just ignore these numbers down here, that's where, there you go, there's the timeline in stated again. Just to state what I just said again. Now, route 1, you could agree to lock in this 1 period rate and then the forward rate, or route 2 must give you the same result. You lock in 2 lots of the 2 year spot. Now, to formulate this, route 1 is compounding the 1 period spot and then compounding the F11. the 1 period forward rate happening in 1 period's time, right? And that should be the same as applying the 2 period spot for 2 periods. That is that's root 2. Now it doesn't hopefully take too long to solve for F11 here. You would divide both sides by 1 spot 0, 2, 1, 0, 1, 2 to get rid of that on the left hand side. That of course will cause that factor to pop up on the bottom on the other side, and then you can subtract 1 from both sides, all right, and that subtracts 1. If you punch this through the calculator, shouldn't take too long. You get 0.0369, 0.03069 or 3.069%. So that's the fair forward rate implied by these numbers. Now you've respected compounding here because you've done 1 plus the rates and multiplied them together, but I'm just going to show you that actually if you're in a multiple choice setting, you want to speed things up a bit, you can, as I implied, you can approximate through addition. Now don't do this if you need to be exact to like the 3rd decimal place, but if we imagine we don't know f again, right? What you do know is that 2.012 plus the f, and this is an approximation, should be broadly 2 lots of 2.539, right? And that gets f out just a little bit quicker. I know it's not saving massive amount of time, but it does. There's less computational error risk as well, isn't there? You know, if I take 2 lots, of 2.539, which is broadly what I earn if I invest over 2 periods, and then I subtract what I get in 1 period, 2.012, I'm going to be in the right ballpark here. So 3.066. Now in a multiple choice setting, just doing that, what's called a linear kind of adding up approximation, is it's usually pretty good. It's going to get you in the right ballpark. And also it really hammers home the essence of the idea of what you're doing rather than just, you know, flooding the slide with, calculations. Okay. All right, so what I've done there is I've done the forward rate. I've calculated the forward rate using the first row of prices. You know, what you could do, I don't think it adds much value with me just doing exactly the same thing again for the second row. All right, in fact, the second row is just getting in the way a bit. This is standing at another point in time with different prices. What you would do is back out your 1 period spot in exactly the same way as you did above. So just copy that and do that again. This is now standing at time, you know, 1 month later, so your time 0 now is June instead of May. So rates have evolved a little bit. Rates have gone up by the looks of things, and the 1 period rate is 2.667, 2 period rate is 3.177. I'll let you back those out. These are just using the prices in the table. And then when you draw the timeline like this, when you're standing at June, you know for 1 year you now get 2.66. For 2 years you get 3.177 for 2 periods. So once again, you know, my kind of approximation will get you home, right? You know, 2.667 plus f is going to be approximately 2 lots of 3.177, okay? And if you do that, you get 2 lots of 3.177 minus 2.667. You know the ballpark that you're looking at here, it's 667, isn't it? The ballpark that you're looking at here is 3.68, 3.69, something like that. When you actually reflect compounding, you get 3.69, right? So with the approximation, I was pretty close again, right? And in a multiple choice setting, if you think about it, you're looking at A, B, C, and so on. You can usually see which one's right just by approximating it like this. It will save you time and it helps with your understanding, doesn't it? But if you do see numbers that are 3.689, 3.684, you've got to be a bit careful because the approximation, this is all an approximation up here, is not going to necessarily help you when we need to be super exact to the 3rd decimal place. All right, so that's forward interest rates. The second application that we're going to do here is looking at forward currency rates. So this is agreeing an exchange rate in the future. Don't forget we're agreeing it now. All right, so this forward exchange rate is actually a rate that we will exchange currency at. It's agreed today, but it's going to be used in the future. All right, used at a future date. These are CFAI ideas. Actually, this is not a CFA example here, but let's have a look at it in any case. So current US dollar GBP exchange rate is 1.25 US dollars per pound. All right. Now, you haven't done economics and FX yet, and when you do that, we'll set up your FX toolkit so you're bulletproof. But as far as we're concerned right now, it's pretty clear we've got for every £1, that's the fixed currency, all right, we're going to get $1.25. That's the thing that varies if that quote varies, is the amount of dollars per pound. Now, we're told continuously compounded interest rates in dollars, all right, and in sterling, reassuringly, because they're relevant. Calculate the no arbitrage 1 year forward exchange rate. Okay, the idea here is that right now the fair amount of dollars per sterling is $1.25 per pound, right? If we kind of scale up to nice round numbers, for every £100, the fair amount of dollars you should have today is dictated by this, what's called a spot exchange rate, because it's the rate agreed for today, transacting today, not for a transaction at a future date, right? Now, if you grow both of these currencies by their interest rates, these currency amounts by their interest rates, you will get to two different numbers, right? For example, if you take your $125 today and grow it at the relevant interest rate, so 2% dollar interest rate, these are continuously compounded rates of return. So you're going to grow by multiplying through by e to the 0.02. I'll just remind you how to do that. 0.02 second ln, okay, gets you to the growth factor, if you like, 1.02, then multiply by 125, and that gets you to, that's 115, apologies. Let's try that again. So 0.02 second ln, that's your growth factor, and then you multiply through by 125, all right? That's how you get to that 127.525. Similarly, when you grow your £100 by the sterling exchange interest rate, all right, the calculation would actually be 0.025. This is for 1 year, of course, so 1 lot of the interest rate, second ln, and then multiply through by 100. And that's how you get your, it's going to be 102-ish, isn't it? 102.5-ish. So there you go. Now, your 1 year forward rate, which we can agree today for exchanging in 1 year's time, is simply this many dollars relative to that many pounds. Okay? Why? Well, because that's essentially the future value of the dollars and the future values of pounds. That's how many dollars there are in the future and how many pounds there could be in the future. So the exchange rate that we should agree for the future is that many dollars per that many pounds. So take your $127.525, divide by 102.532 pounds, and you get 124. That's your fair forward rate agreed today for a transaction that occurs in 1 year's time. Okay, the final thing we're going to do with this no arbitrage, all of this is no arbitrage applications, by the way. If this is where the forward rate for currency is where it should be. If it's not there, then you could use that actual forward rate to earn risk-free profits, all right, by borrowing and depositing and holding balances over time to earn interest rates. But you'll actually do that in economics when you cover this idea, what's called interest rate parity. Okay. All right, on now to the final application. We are going to look at valuing an option. Once again, defer this to after derivatives. If this is hurting, don't worry about this too much right now. Only worry about this if you've done derivatives already and it's still hurting, because this is what we're applying here is actually right at the back end of derivatives. We're applying what's called a binomial model. We're saying that there's some sort of stock. It's priced in Chinese yuan here, CYN 40. That's its price today. And a binomial model, as the name suggests, by binary, there's two outcomes. All right, the stock could go up a higher path, or the stock could go down a lower path. In this case, we're modeling that the stock could go up to 56, or it could go up down to 32. Right? So it's quite a simple world we're looking at, but there you go. Now, if you had an option to purchase this stock with a strike, as it's called, of 50, and that option matured or has an expiry in 1 period's time, you know that if the underlying goes up to 56, you will certainly choose to purchase the stock at 50. Right? That's what you've got the right to do under this, what's called a call option. Call option is the right to buy something. Okay, so if you've got the right to buy at 50 this stock in 1 period's time, you'll certainly exercise that. You'd pay 50 for something that's worth 56, wouldn't you? So if we go on this up branch, you'd certainly exercise your option, pay 50 for something that's worth 56, and the right to do that would be worth 6. It's your exercise payoff. We're assuming that the option expires here, so there's no further value in, keeping the option open. It expires. However, if the stock goes down to 32, only somebody, nobody in their right mind would pay 50 for something that's only worth 32, right? So we don't exercise the option and we throw the option in the bin. It's worthless. We throw it in the trash, okay? So these are your option payoffs, as long as the option expires here and there's no further time to play out, right? This is what's called expiry of the option, okay? These are the two potential payoffs. Now, what you can do to price this option is you can calculate a certain number of shares that you hold alongside the option in order to get a certain payoff when you combine the shareholding and the option. Once again, more in derivatives, but this is what's called the hedge ratio. The hedge ratio gives you the number of shares that you should hold to remove any risk from this payoff, to give you a risk-free payoff. All right, number of shares to hedge a position, one option. All right. So the hedge ratio is nice and easy to calculate. You just look at how big the option payoff moves relative to the underlying share price. Okay, quite intuitively, this hedge ratio, if it's a half, for example, then you only need half a share to hedge this relative movement in the option relative to the share price movement. Okay, so this hedge ratio here, what we're going to do is we're going to look at how much the option can move. It can move up to 6, or it could go down to 0. So the numerator here is 6 minus 0, which is 6. All right. We're going to think how big that is relative to the movement in the share price that we've had, which is a movement of, could go up to 56 or it could go down to 32. So that's where those numbers come from. The movement in the share price, which has generated this movement in the option value, is, what is that? 24, isn't it? So 6 divided by 24 is a quarter. There you go. You only need a quarter of a share to hedge one option. So imagine if you did hold 1/4 of a share and you sold an option. You're selling the call option because it's moving in the same direction as the underlying. So you're creating a hedged portfolio by buying 0.25 shares. That came from your hedge ratio, all right, and selling one call option. By the way, time out, right? In this bit, they don't talk about the hedge ratio. We're bringing it in from derivatives to help paint some color, all right? So if you're worried about the hedge ratio, once again, do derivatives first, come back to this and you'll go, that's the hedge ratio, that's fine, okay? So don't worry and get stuck and hung up on the hedge ratio here, okay? Just look at how we're using it. Okay, time back on, right? So we're gonna buy one share, we're gonna buy 1/4 of a share, that's the hedge ratio, and we're gonna sell one call option, okay? If you do that, you've got a portfolio that will always be worth 0.25 of a share and -1 of the call option, -1 of the option, okay? So if we go up in our binomial world to a share price of 56 and an option value of 6, what we know is our portfolio will be worth 0.25 of 56 minus one option, which is worth 6. We've got a portfolio worth 8, right? 0.25 of 56 must be 2. Must be 14, mustn't it? Yeah, 0.25 of 56 is 14. Okay. Notice that if we go down to here, right, we don't know where we're going to go right now, but if we go down to here, shares worth 32, options worth nothing. So your portfolio, your hedge portfolio, will be worth 1/4 of 32, which is 8, minus nothing, which is 8. So there you go. This is us demonstrating that we have, by using the hedge ratio, we have created a risk-free portfolio that will definitely be worth 8 in 1 period's time, no matter what happens. That is a hedged portfolio. Now, here's the nub, and this won a Nobel Prize, right? If you've got a portfolio containing shares and options. It's actually 0.25 a share minus one option, right? And it's definitely going to be worth 8. That is a risk-free payment of 8. You can discount that risk-free payment of 8 back at the risk-free rate because the relevant discount rate for a risk-free payment is the risk-free rate. It's what's called risk-neutral pricing. And it got Black-Scholes, like I say, a Nobel Prize because it's a crucial tenet of their models and everything that's come from it. This idea that we combine options with the underlying to create something that's risk-free, discount at the risk-free rate, there it is, 5%, and we get the value of the portfolio today. So let's do that. We definitely got 8 at expiry, no matter what happens. We discount by the risk-free rate because it's risk-free of 5%, and we get 7.619. Now think about what that 7.619 is. That is 0.25 of the share today minus one option. Well, guess what? We know what the share is today. It's the only number we haven't used, isn't it? It's that one. There. That's the share price today. So we know that 7.619 is 0.25 lots of the share price today minus the only thing left unknown, which is the value of the option today. Well, we can back out the value of the option quite quickly from this, right? Just to show the keystrokes here, you're talking about 0.25, or just to show the algebra, 0.25 lots of 40, right? Minus the call option today is, we've said it's 7.619. That was the present value of the risk-free payment of 8, okay? What I can do is maybe add C0 to both sides. So C0 pops up as a positive over here, all right, and disappears from the left-hand side. And then I'm going to subtract 7.69 from both sides. So it disappears over here, but I need to subtract it on the left-hand side, all right? And by the way, 0.25, a quarter of 40 is trivially 10, okay? So C0 is 10 minus 7.619, which is fiddly enough for me to have to do it on the calculator, but it turns out to be 2.381. That's the value of the option today, according to this model, right? So this is where the 2.381 comes from, and you know, that is our first valuation of an option. Now, I'll just say it once more because I think I do need to. In that last section, when we were doing forward rates, foreign exchange rates, and the binomial pricing of the option, there was a lot of ground that we were using that we haven't really covered. So my advice, and it's become a stronger piece of advice as we've gone through this material, is to have a look at this, think that's either okay or it's not okay, but don't worry too much. Go and look at bonds, fixed income, go and look at equities, go and look at economics, foreign exchange, go and look at derivatives, come back to this, and you'll be like, this is fine, okay?